following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp, brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and John Critchley.
All right, everybody, welcome back to Options Bootcamp. This is the program where we take you, the raw options recruit, and we break you down through a series of just torturous processes and then rebuild you into seasoned options veterans. My name is Mark Longo from the OptionsInsider.com, as well as from this here Options Insider Radio Network. And I am pleased to be joined, as always, by my compatriots, my boon companions, the collective yins to my yang, if you will. Starting off with the man beaming in all the way from the great state of New York, soldiering on in the face of walking pneumonia because boot camping is just that important to him. He is none other than the options major domo over there at SogoTrade.com, Mr. John Critchley. John, welcome back to the program, sir.
Hi, folks. It was the first show of the year. I couldn't miss it. I'm a little sick, but I'm excited to be here. The polar vortex. I claimed a victim myself, but I'll be okay. And so much for global warming, and I'm looking forward to the show.
See, this just proves your commitment there, John. Polar vortex be damned. Walking pneumonia be damned. We will boot camp or be damned. And so we are going to do some great boot camping today. I can feel it in my bones. And last up on the old program, some may call him the prima donna. I just call him Mr. Dan Passarelli, the founder and major domo over there at Market Taker Mentoring. Mr. P, welcome back to the program, sir.
Well, gosh darn it, Mark and John, it is great to be here. And it's a little bit nippy here in Chicago, too, I might like to add.
Yes, it is a wee bit, shall we say, less than balmy here in Chicago. We're a little bit beyond the massive polar vortices that descended upon the city last week, so it's a little bit better than that. We're probably about 50 degrees warmer than that. That's not to saying it's very warm here, just that it was pretty damn cold about a week ago. But nonetheless, we've all thawed out, at least except for John, and we're ready to dive right on into our basic training segment.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Call in. Prepare to learn. Yes, sir.
I love whenever that theme music plays because it just makes me think of summer and the 4th of July, and I just get all warm and toasty inside, which is nice when we're recording this deep in the doldrums of January here in frigid and frozen Chicago and indeed in frozen New York City. And as we were kicking around some ideas for what to talk about on the old show, it suddenly occurred to me we talked to a variety of different strategies for doing this exact thing we're going to touch on today, but we've never actually put it all together in one conversation. I'm talking about the wheel trade, something that is very popular amongst a lot of advisors, financial planners, and also a lot of retail who like to use it as a way to kind of get income coming in and some income going out. I know our friends over there at RCM Wealth Advisors like to call this the wheel of fun type trade, a.k.a. the triple income strategy. I've yet to figure out where they get the third part of the income, but maybe that's a conversation for another day. So what are we talking about here when we're talking about wheel trades? Well, it's a very, very simple approach, and yet in the simplicity lies some of its genius. We talked before on the show about writing short puts, cash secured or naked, as an alternative to working limit buy orders in an equity. That's been something we've extolled many times here on this show, getting paid to work limit orders as opposed to just working them in the stock for nothing. So that is the first leg, the first component of the wheel trade. That is how you're going to get into this trade. You're going to find an underlying that you like. You're going to identify a level in the stock that you may be comfortable or willing to buy it in, and you're going to write your put there. And you're going to collect whatever little income you get from that. And now, as in any put writing scenario, if the underlying stays where it is or it rallies a little bit, you keep that income and you're free to do that trade again and again and again. If the underlying drops to around the level or maybe a little bit below where you're thinking of buying it, now your limit order is essentially filled and now you buy the stock at that strike, but a little bit lower because, of course, you collected that put premium as well. And so now you're into that underlying at a price level that you're comfortable with, at a level that it was a discount to where it was trading earlier. So that's what the first income leg, quote unquote, is of that trade. And now you have this underlying position, and what do? Well, what do a lot of retail traders and what a lot of traders in general like to do when they have a long equity position? Well, they turn around and like to generate some income on that. So they write covered calls on that underlying, and that is the second component of the wheel trade. It's how you get income going out as well. And so you can write that call in a variety of different ways. You can take the standard path. Maybe you turn around and say, okay, here's where the underlying was when I initially saw this trade. I'm perhaps going to write my out-of-the-money call at that strike. So if the underlying retraces back to that level, I've now made the appreciation on that strike differential plus the premium I collected coming in and going out. I've done fairly well on this trade. If you've readjusted your opinion of the underlying, or perhaps you don't want to carry it that long, you can write a more in-the-money trade to help get you out of that underlying faster and collect some income going out there. There's a lot of different ways you can construct that second leg of the wheel, and then that in turn allows you to exit that underlying position for some sort of income. At least you hope, in most scenarios. In a worst case scenario, of course, if the underlying keep dropping, it's just like owning any other underlying position. You have those same risk cases. But in this typical wheel scenario, you're getting paid to put it on, you're getting paid to take it off, and in between, you're making some sort of income in the middle there as well. So it's a pretty attractive trade. You can see how simplistic it is, and yet it kind of harps on the narrative we've hit on many times on this show, which is you don't have to go crazy. You don't have to do exotic 1-by-3 ratio swaps or anything like that to really maximize the options potential of your own portfolio. These are very simple, basic steps that when used in conjunction can make entering and exiting an equity position a lot more profitable and a lot more attractive to a lot of people. Now let's turn our gaze southward here from Chicago to the warm and tropical climes known as let me start that over. To the warm and tropical climes known as Frankfort, Illinois, where the black-hatted one, a.k.a. Mr. P, is waiting to give us his take on the wheel trade. Now, Dan, when your clients come... I turn myself down. There we go. Now, Dan, when your clients come to you over there at MTM and they say, Mr. Passarelli, what do you think of this wheel trade, a.k.a. the wheel of fun, a.k.a. the triple income strategy? What do you tell them?
Well, I tell them it can be a really, really great trade. The one thing that I caution people about, and I think we've talked about this on the show probably a few times, about selling naked puts or cash secured puts, rather, in this case. The only thing I caution people about is, make sure you know yourself. Make sure you know your objectives. And if you're selling a put, you are an investor who is fine holding something for the long term and going through the entire life cycle of this wheel, and you're okay with that. This is not for what I would call traders, people who are just trying to make a buck on collecting some premium. You never want to own the stock. Don't talk yourself into it. Don't lie to yourself and tell you, I'd be happy owning the stock here, because you might end up owning the stock several dollars below where you actually get assigned. If you're an investor, that could be okay, and that's what the second part of this, and possibly subsequent parts after that, selling that covered call against it, could be a really, really great trade. Could be a longer term trade, though. This is probably a 1 to 2 to 3 month process. Could be even longer if you end up skating on the call the second time around and end up selling a call another month and selling a call another month. So be prepared to be in it for the long haul. But I love it. It's what I would consider an investment augmentation strategy using options, and it's a great way to grind out income.
All right, and Mr. Critchley, in between your bouts of walking pneumonia, give us your little take here on the wheel trade.
I mean, Dan really hit the nail on the head. We have some of our best customers that I speak to. This was actually a strategy that, as a trader, I might not employ that much. But for the retail customer, it's a great strategy. And some of our best customers that I talk to would have this strategy on where they would sell puts every month. And then when I talk to them, I say, you do know if, I think Cree was one of them. If Cree goes down big one day, you're going to own the stock. I know, John. Well, sure enough, that happened. They owned the stock, but they had sold puts for like 8 months straight. Then they took possession of the stock. And then the same customers, it was some customers I speak to, started selling some calls, out of money calls. And guess what? Cree rebounded a little bit, went right back up, but they sold calls for like 4 months. And then it was a net big winning trade. So the point is, this is a kind of a new terminology for me, the wheel trade, the triple income trade. But it actually, as Dan says very correctly, it is like an investment augmentation strategy. If you know what I'm saying, it's an 8 month, 1 year, 6 month maybe strategy. And if you do it properly, you really know what you're doing, it can be a great strategy. But again, the one time you shouldn't use it, and you know what I'm going to say now, I always caution is, and Dan mentioned this also, there is gap risk. Please don't use this trade, I don't think, going into maybe a FDA ruling, maybe an earnings ruling, or if you fear a big down move, because you may own the stock much higher than where it's trading at.
Yeah, if you're doing this in your proverbial biotech or some of the other names where you can expect a big vacillation, then it may not be the ideal use case for something like this. But, one of the reasons I wanted to bring it up on the show today is because so many of our listeners, particularly this program, are looking to find some ways of using options in conjunction with stock. And this is a great way to use options coming in and options going out. And, you're right, Dan and John, both of you could end up wearing this trade for a little while. Some people like to see it as more of a shorter term, and certainly it can be if you're using things like weeklies and things. It could be a relatively quick turnaround, unless, of course, you do get a significant movement in the underlying. Then you could end up wearing this underlying position for a while. But one of the nice things about being able to get income coming in and going out is that in the case John illuminated there, where you're probably going to collect some income for a while coming in before you ever, if ever, actually get assigned on those puts. So for a while there, you're collecting income, which is something you can put against that underlying position. Then if you turn around and writing calls for a while, you're collecting income on that as well before you end up getting called away. So there are a lot of ways to, even if you do have a little bit of a down move in the underlying, to offset that by collecting income through the various legs of this trade. So this is why I think the wheel is an interesting one. And you're right, the name is kind of weird. The wheel, I like the Wheel of Fun. I think it's a little bit more silly, which is also kind of fun. Triple income, again, I said I don't really, I'm not surely sure how all those three legs of income come about, but c'est la vie. It was interesting. A lot of people actually in our audience pointed us to a show that NPR did last week with a financial advisor, where they were pretty much, as usual, slamming options as being riskier than penny stocks, and this guy counseling people they should never invest in a product that has a negative expected return like an option because it's an insurance vehicle, et cetera, et cetera. I would love to walk them through something as simple as this and say, hey, look, here's a great use case for your retail clientele and options. They're getting paid to work their limit buy order in the stock. They're getting paid to get out of that stock. This is the way every single financial advisor should be exiting and entering their underlying positions, and yet so many of them aren't. So, yeah, it's an interesting one. It's very simple. But yet, I think when people start to grasp their heads around it, they see the intuitive advantages that offers. So next time you're looking at an equity position, say to yourself, hey, I think I actually want to buy this one a little bit lower, or I have a level in mind that I want to buy this in. That's where you write the put, and that's where you begin the wheel of fun, to borrow that term. And then if you do get assigned, you probably get a few months or a few weeks of income out of there first. Then if you do end up getting assigned, now you turn around to the other leg, you decide where you want to get out, and you write some calls on that level. And that combination turns into this income generating trade that is a way to, because everyone knows the covered call. Everyone knows how to buy equity and sell that covered call against it. That's kind of the standard income trade. What you're doing here is adding what you can call really the short put kicker. It's a way to get that extra boost of income. So if you really want to tweak your returns up a little bit, you really want to add more of an income stream to your trade than just you can by writing covered calls, then this is an interesting way to do it. Mr. Passarelli, any final thoughts here on the old wheel trade before we roll on into all these great questions from our listeners here?
No, just highlighting the stuff we talked about. Just if you are an investor and you typically buy and hold stocks for a long time and you've never really traded options before, this, once you really fully appreciate how it all works, this might be an excellent addition to your investment strategy. There are times last year when the market did nothing but go straight up and all the buy and hold people did really, really well. This year, nobody really knows for sure what's going to happen, but it's shaping up to be probably not the same as last year. And I think it's not going to be the same as last year. And people need to look for alternatives to just simply buying stocks and holding them. And this could be a really great alternative because it can profit if the market goes sideways. And it's something that I think all investors should have as one of the tools in their toolbox.
Yes, and if you're an investor out there and you have a financial advisor who is putting on equity positions for you and he's not cognizant of a simple strategy like this as a way to maybe boost some of the income from your portfolio, then A, you should listen to our Advisors Option Show where we talk to those guys and tell him to listen to it. And then B, you should probably look for another financial advisor who can help boost your returns a little bit and bring a little bit more of a skill set to the table than just the standard guy who says, okay, you're 60, 30, 10 equities, fixed income, and maybe a little bit of metals, and that's kind of he's done. He set it and forget it type of guy. So,
well, how are you supposed to golf if you're
that's true.
Managing option
that's
positions,
true.
Mark?
I will say, I think that financial advisor on NPR, I think he did actually use that term, set it and forget it, when he was talking about what these people should do for their retirement. I had to just kind of put my heads in my hands and say, really? See, that's the problem with these extended bull market periods. It turns people like that into heroes, and so they think that that's a reliable long-term strategy. C'est la vie, a conversation for another day. We can debate buy and hold all day long, but it's not time for that. It's time to keep on going right on into our next segment. Quite frankly, my favorite part of the show because it gives you guys a chance to sound off. Yes, it's time for the mail call.
Mail call. Time to look at questions submitted by our listeners.
All of our transitions for the show really have a distinct 4th of July feel to them, so it certainly does warm up the cockles here in the dead of winter. Welcome to the mail call. This is, as the name implies, the portion of the show where you guys get a chance to join Dan and John and myself here on the old Bootcamp drill instructor squad and let your voice be heard. And we're going to kick things off with a question from a user who goes by the handle BitTim. Maybe he's a big trader of Bitcoin. I don't know. He writes, you recommend closing out your shorts when they go your way. Do you advise factoring the closing price of the trade into your calculations when writing options? For example, write a put for 30 cents, but know at the outset that you only collect 25 because you'll close it out for a nickel. If more people did that at the outset, they might be less reluctant to close out their winners for a profit. Thanks, BitTim. Well, Mr. BitTim, It's actually a great idea. I think it's a great way to view premium harvesting, income generation type things, because all too often, as we've discussed here on this show, people will write an option for whatever amount, 30 cents, as in your example, $1, 20 cents, whatever. And they will just keep in their head, hey, I'm collecting all of that. They see that debit in their account, or I'm sorry, they see that credit in their account, and they think, wow, that's my money. I'm keeping that. And so that's when they start getting into trouble, because it'll often go their way, and then once it gets below a dime and then gets down to a nickel, that final nickel is a difficult road to hoe, and that could take as long sometimes as the first 20-odd cents or whatever it is to actually have that nickel come in, particularly if it's vacillating around the strike and there's a lot of activity, a lot of volatility in that name, and it's going in the money, out of the money, in the money, out of the money. You may never get it below that nickel level. So a lot of people, I think if they went into their short premium trades with that type of mindset, it might actually be, I think, a good thing, because they know going in they're not going to risk it all and risk whatever else, the previous 25 cents just to get that last 5 cents. They're going to take it off and move on to the next thing. Is that something you advise your clients as well, Mr. P?
Yeah, you know what? We just had a guy yesterday, and I kind of forgot what stock it is. Netflix. Yeah, I think it was Netflix. This is a guy who's actually, he's a pretty smart trader, but his thing is selling naked puts. And he sold, I'm pretty sure it was some Netflix puts for like 50 cents or something, and he just bought them back at like $4.
That's a familiar refrain in Netflix. They don't call it the Widowmaker for nothing.
Yeah, no kidding. And so, I mean, that's the rub. This is buying back your short options is what separates the amateurs from the guys who make money in the long term. Because this client of mine, Scott, he's made money for years selling naked puts, but every once in a while you get whacked pretty good. And really, to be fair, selling it at 50 cents and buying it back at 4, yeah, you lost, 7 times what you could have made, but that's really nothing. I mean, I've seen guys buy it back, try and make 50 cents and buy it back for $25. You can get totally annihilated by selling naked puts. So, yeah, I mean, it's just amateurish to just let it dangle out in the wind, just kind of hoping to make an extra penny. And the way I help my students to rationalize it is always look at it at risk reward. So, okay, imagine you sell some puts at 50 cents and there's a month until expiration and 3 weeks go by. There's one more week until expiration and there's only 2 cents left. You can buy the puts back for 2 cents. Okay. So scenario A, you don't buy them back. What's your risk reward look like? Well, your potential reward is you can make an extra 2 cents, $2 of actual cash per contract. Almost nothing. But if something crazy happens, which doesn't happen all the time, otherwise we wouldn't be having this conversation, because, the problem is that people make money, and they build this false sense of confidence, and they think that, this bad thing's never going to happen to me. But when you can buy an option back for 2 cents, the most you can make is an extra 2 cents, but you can lose $10, $20, $30. If something highly unlikely happens, but these highly unlikely things do happen time to time. If something really bad happens, you can get creamed when you're trying to, you're screwing around trying to make an extra couple pennies. Or scenario B, okay, you pay up and you cut, 5% off your maximum profit potential, and you don't get annihilated this time around when something bad happens. So, I mean, it's a no-brainer, man. Me and Mark and John, we've all been doing this a really, really long time. We're not just like making up these rules in theory. I mean, I'm personally passing along this rule because when I was a trader on the trading floor, I had negative 6-figure days. No, I'm saying plural. I can really only remember one that taught me this lesson, where I thought, hey, man, yeah, I'm short a few puts down there, but nothing bad's going to happen. And then something bad happens and I'm down into the 6 figures. Boom. Overnight. gap risk, like John mentioned. I think it was John that said that. So, this is a reality. You will get annihilated one day by not closing out your shorts. I mean, not making up this rule. I've seen it happen to me. That's why it will never happen again to me or to any of my students who listen to me.
On the plus side, though, that nice cardboard box you have in the alley, I think really speaks to your lifestyle and really complements your wardrobe there, sir. You came out of that pretty well.
I made it back, Mark.
Yeah, I just want to add one really quick thing. The last part of his question I wanted to hit on when the customer says if more people did this calculation, they might be less reluctant to close out their winners for a profit. And I know Dan just hit on that. I didn't like the tone of the insinuation of that, or insinuation of that part of the question. You need to pick a point where you're going to buy something back, and if you're not willing to sell it there, just buy it back. So, listen to Dan. Dan did a great explanation. We've done podcast after podcast on this issue. Please buy them back, and at some point in the future, we're hoping Sogo will be able to give you a discount on these closing trades.
A couple good things there. First off, Mr. Bit Tim and everyone else who's thinking about doing this, probably a good thing when you're putting these trades on, once you get filled, to work that closing leg in the platform right away. Say, okay, I'm just going to work that nickel bid right now. And so if it gets down there, bam, it's out of your hands. It's systemic. You're filled and you move on to the next trade. You don't have to hem and haw about, wait a minute, should I move to 3? And of course, if things don't go your way, you can adjust to the other way. But hopefully it doesn't happen. But that's a good way to get around this step one, is to say, okay, as soon as you put that trade on, put in your closing bid where you're going to close it out, and then you're done. You're on to the next trade. And that way, at least, you don't have to worry about entering that order later where you may want to stop yourself and think, I can get another nickel if I wait a couple of days or a couple of hours. You don't want to be in that position. And then B, what John said applies. It's a great rule of thumb. As you're watching these puts or whatever you're short come in and decay, ask yourself, hey, would I sell it again here? And if the answer is no, I wouldn't sell this put that I sold for 35 cents. I probably wouldn't sell it again for 12 or 8. Then it's time to start thinking about closing that out. And particularly if it gets down to a nickel or so, anywhere south of a dime, particularly a nickel range, and you ask yourself that, would I sell it for a nickel here with X number of days to go? And your answer is no, then you should be closing that out. So 2 good rules of thumb, and one best practice to implement when you're putting these short premium trades on. Put the closing leg on in there as well, and let the system take care of it for you. All right, next up, we have a question from Jack. I believe this came in from the website. This actually came in one of our other shows. We discussed it a little bit there, but I thought it'd be good to revisit this discussion on this show as well, because a lot of our listeners here are concerned with the tax consequences of options. In fact, maybe we'll have to devote a whole show to that down the road as we get a little bit closer to tax time. But this question here from Jack says, I know you guys are not tax advisors, and so nothing you say can be taken as certain in any answer to this question. I'm a small-time trader and at the moment cannot afford a CPA with trading expertise in options to do my taxes. So I am wondering if you can talk about the potential tax consequences of front spreads, aka ratio spreads, listeners, especially when used as covered call replacements. I've had good success with this strategy, and I would like to move it into my margin account this year instead of just using it in the IRA to avoid the tax headache. Thanks, Jack. Well, Jack, it's an interesting question. Like I said, we touched on it on Options Bootcamp. We touched on it in Option Block. If you want to listen to our conversation about it there, tune into that show as well. But it's an interesting question, and it gets into some of the interesting nuances of tax trading, and indeed of using options in a variety of different accounts. Covered call being kind of the typical retirement account trade everyone does in their IRA. It's approved in the IRA. You don't really have any naked leg risk, so they allow you to do it in your IRA. And now he's talking about replacing that with essentially a ratio. Front spread is a ratio spread. Remember, we talked about ratios on the past. Listeners, it's essentially where you're long 1, let's say, at the money option, and short 2 out of the money options, or short 3. You do it on some sort of ratio, 1/2, 1/3. And that's what he's talking about. And that raises a couple of interesting questions. First off, I don't really consider that to be a straight-up 1-to-1 replacement for a covered call type scenario, because you have a naked short component to any sort of ratio spread, depending on what kind of ratio you do. That's how many naked legs you have hanging out there. So if you're short 1/2, or if you're long 1/2, then the underlying rallies, guess what now? You're short 1 and once you move past the short strike. So I think for a lot of brokers, that may not be equivalent And you probably couldn't do a straight-up ratio just in an IRA. What's your take on that, John? A front spread, a.k.a. ratio spread, versus the covered call, both from a margin and from a tax perspective?
Boy, this question is we could do a whole show on this. Maybe we should. But let me kind of backtrack just a little bit and answer your question a little bit in a little different way. Let me just touch on a few points here. And it's not really answering the question right now, but I promise I will get to it. The first thing we tell our customers is we're not tax advisors, and options have different tax implications. So please consult the tax advisor for what the best strategy might be for your best consequences for yourself. Watch out for these things called wash sales. Customers, a wash sale refers to the buying, selling of the same security within 61 days. Now, I know it's not answering the question, but I just want to make people aware of that because a lot of people get caught in that trap. So I wanted to hit on that. As far as the question at hand, I'm trying to think how the best way to answer it is that. Let me see here. If you have a covered call on, this is I think one of the questions that the customer asks. You have a covered call on, and let's say you buy stock at 100, and you sell the 105 call, and now all of a sudden the stock goes to 107. Okay, I would think, and the tax advisor may advise you to buy back the call, okay, instead of having the stock put to you. Because if the stock is put to you, then you're going to have to pay, the gain is going to be a short-term gain on the stock. If you buy back the call, which would probably be for a little bit of a loss, you can just keep rolling. So that's one of the questions. And the other thing is, when you're doing these front spreads, options, mostly long-term gains are considered a year or more. So they're kind of tricky when you do the spreads for tax consequences. So again, consult your tax lawyer. I know the answer was kind of convoluted, but there's so many different tentacles here that I think it may be a show we should do on this whole thing.
Yeah, the more I think about this, the more I think we could easily do an entire program on just the nuances of options when it comes to tax time. Mr. P, I know you're not a tax advisor either. What's your take just in general on a ratio spread versus a covered call spread, as seeing the two as kind of fundamentally equivalent?
Well, I think there's a fundamental difference. With the ratio call spread, you're naked one option, right?
That's how I was brought up to believe it.
So personally, I think it's a very different trade. Now, to be sure, we can have the exact same conversation about covered calls as we just did about naked puts. Same kind of concept. You have a whole bunch of risk to the downside, so that's really only for long-term investors who are buy and hold and really like those stocks as long-term investments. But it's a very, 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 very different thing than a ratio spread, because there you have unlimited risk potential to the upside. I don't know. I don't really see the similarities. I see more differences than similarities for sure.
Yeah, I would think that the naked short leg would make that ratio spread not qualified for an IRA, so you couldn't do it in an IRA. You'd have to do it in a regular trading account. And
I would think the same thing.
Yeah, and then on top of it, you'd have, I'd imagine if you're doing just front spreads over and over again versus covered calls, you're going to have more taxable events, I would think. Just because covered call is typically for a lot of retail, set it and forget it type strategy. They put it on, maybe it gets called away. They set it again the next month or the next quarter, the next week, whenever their time frame is. Versus ratio spreads, you can do a lot of adjustments, a lot of taking them off, putting them on again. So I'd imagine just from a taxable event perspective, there'd be more going on, probably from a ratio spread perspective than it would be versus just a simple covered call perspective. So if that's your concern, you don't want to have as many taxable events, or you don't want to be spend all day filling out your Schedule D and whatnot, then maybe the covered call is the choice for you. But I think this question opens up some interesting doors for us, Jack, and I think we'll probably have to explore this more in much more detail here on an upcoming show on the tax implications of trading options. But for now, we're going to roll on into our final question in the old mailbag for today. This is the question from Alejandro Garcia in your neck of the woods, John, right now in New York City. And he writes, given Wang's experience in the Chinese market, I would be interested to hear John's take on the impending launch of listed options in China in April. Does he think it will be a success? What will the popular strats be with Chinese options traders? Now, listeners, if you're not familiar with what he's referring to, China is going to finally give approval to and launch listed equity options in April. That's at least the plan. So a lot of people are looking to that for an interesting window into the Chinese market and perhaps the onset of an entirely new class of options customer here, both in the domestic Chinese market and probably spilling over into the U.S. market as well. And our listener correctly points out that you guys over there at Sogo have some unique insight into this audience and into this clientele, John. So go ahead and let our listeners know what your take here is on the impending launch of options in China and what you think the Chinese traders will be up to.
Well, as many customers may know, Sogo Trade has a growing presence in China. We're focusing on China, Chinese market. We have a lot of Chinese speakers, and for our Chinese customers, and we have a Chinese website and platform, et cetera. Most of our Chinese customers, they're well educated and they do their due diligence, and many of them like to sell premium, especially puts. But let me get back to the launching of the options. They're doing a pilot program, and I think it's going to they're going to do a full launch in April 2014. And when I did some research on this and I spoke to my Chinese associates, I found out that there's a few interesting things to share with everybody. The first thing is the multiplier, instead of being normally 100, is going to be 1,000, 5,000, and 10,000. So the multiplier is going to create more leverage for the customers. These options are going to be European exercise, which is different from the U.S. marketplace. The requirement for an opening account for these is going to be you must have a margin account and you must maintain 50,000 RMB, which is about $85,000 U.S. equity. And this is really interesting. The individual option investors, they're required to take an option-related exam. And then they'll be classified into 4 different levels, A, B, C, and D. And lastly, they are required to have 3 months paper trading experience. Now, this is the information that I've been able to put together. So I think it's the Chinese marketplace or regulators are being very, very careful with this, but it's going to help Sogo Trade, and it's also because what we offer and the Chinese customers and the Asian customer in particular have a reputation for having a gambling mentality or bent, which is to some degree true, and some of our best customers. So when these customers see us roll out in Shanghai, give an opportunity for us to go in there and say, hey, come to the U.S., Wesley, you don't want all that leverage. You don't want $85,000 in your account. You don't want to take all these tests. But I will say one thing, I do applaud the regulators in Shanghai. If what I read here and what I'm saying is completely accurate, that they're at least taking the steps to make sure there's some education level, although it may be overkill, for the customers, to protect the customers.
That's the first I heard about the 1,000 multiplier. That's true. That's crazy. We're going the complete opposite direction here in the States. We just launched mini options with a multiplier of 10, and they're launching their entire options business essentially with a multiplier of 1,000. If you remember, listeners, the multiplier, of course, is the number of shares that your options contract is on. So if you have a multiplier of 100, like you do in most equity options and index options here in the States, it's for 100 shares of the underlying stock. In this case, in China, it's going to be for 1,000 shares. So use your imagination as to how much these options are going to cost, and how, if you have a 10 lot on, you have some serious exposure. So that's just crazy. I'm gonna have to dig into that a little bit more myself. That's the first I heard, like I said, of that 1,000 multiplier. But if that's true, that's certainly interesting. I guess it makes sense then. If you're going to require 1,000 multiplier, you want people A, have some sizable accounts, and B, have a little bit of experience, because that's pretty easy to blow out on pretty quick. Now, Mr. Passarelli, a little birdie told me that you once took a trip over there to the Orient. What was your take on the Chinese investor and the Chinese audience and the potential for the launch of options in China this year?
This is going to be interesting, ladies and gentlemen. I was over in China. I started in Hong Kong and was in Shenzhen and Guangzhou and Shanghai for a total of just about 3 weeks in the fall. And I talked to a lot of the people at the major exchanges over there. I talked to some of the major brokers over there, and I talked to some of the people who were applying for market maker status over there. And long term, I think the Chinese have incredible potential with option trading. In the short term, they're going to have a whole bunch of growing pains and a whole bunch of kinks to work out, which might sound like I'm saying something bad when there's pricing inefficiencies and that sort of thing in a market scenario. That's an opportunity for people. So I think American professionals are going to have some really incredible opportunities for some insane profit potential, probably during the first 6 months of option trading there, because I think they're going to be figuring stuff out for a while. There's a lot of things that some of the professional trading firms over there have incredibly way dialed in, and there are some things that are seemingly very, very intrinsic to anybody who's ever made a market in their life that just kind of goes over their heads. So it's a really, really interesting and exciting time for what's going on in China. And man, I don't know. I look forward to continuing to be a part of that, and if nothing else, be a spectator.
Yeah, it's kind of reminiscent of the early days of options here in the States when there weren't even puts, and it was just a complete Wild West, and no one really knew where anything was and what the relationships between the different products should be. And, clearly they're starting a little bit of an advantage over there in China. They're not that remedial as we were here in like the 70s and early 80s from an options perspective. But still, you're right, there's going to be a lot of great discrepancies, and I'd imagine a lot of prop firms here and a lot of algo shops here are already salivating at the launch of those products, because it's going to be some interesting opportunities. Why fight for pennies here in the States when you can go over there and collect $1 1,000 times in China? That's very interesting. And John, you kind of concur with the thought process that is probably going to be a lot of premium buying to start off with and not a lot of premium selling like we see here in the States?
No, I think there's going to be a lot of premium selling. Some of our biggest premium sellers are some of our Chinese customers. And I just wanted to say one thing, from what I'm reading, now I had to do a little more research on this and speak to my associates in Taiwan a little bit more. But I've been told the multiplier is it's going to be 10,000 for some ETFs, 5,000 for some blue chips, and 1,000 for like the more volatile things. I mean, I have to double check that. I hate even saying it was incorrect though. Although I did double check it this morning, but I had to go back and I couldn't find too much information. Readily available in English on this. So, but I'll do more research on it. But it's a good, my Chinese associate are telling me that that exactly what Dan said. He hit it right in the head. In the short run, there's going to be a lot of problems, regulation, insider trading, risk management. But I think in the long run, it'll be a success because the Chinese nature, they like the options, they like the high leverage, they like the gambling aspect. So I think it's going to be a success in the long run. The short term, there is definitely going to be some growing pains and opportunity for maybe some of these Chinese customers to say, you know what, these markets are too crazy. Let's go to the U.S. markets. Let's go where it's a little more stable and maybe get some better prices. So that can be an opportunity for Sogo Trade or for some U.S. brokers.
Yeah, that'll certainly probably be the case if those multipliers turn out to be true, because that's pretty much the government and the regulators over there saying, yeah, you probably don't want to trade these. We're going to put these way out of everyone's reach except for a handful of people. 10,000, that's crazy. But yeah, we'll dig into this a little bit more. Listeners, great question, Alejandro. Maybe this will be an interesting topic for a future show as well, the onset of Chinese options, maybe some of the different strategies we'll see employed over there, the different ways that marketplace may unfold. We'll, of course, know more as April approaches and more of these details get disseminated out here into the marketplace. We'll keep an eye on that. Alejandro, great question. And great questions for everyone else who wrote in today. If you'd like to join your fellow listeners here on the Options Bootcamp program and make your voice heard in our mail call segment, a lot of great ways to do that. Of course, you can join us by posting a comment on the show notes there, and we'll, of course, route it to the appropriate program. Reach out to us the old-fashioned way, questions@theoptionsinsider.com. Be sure to put question for Options Bootcamp in the subject line. Or you can find us on social media, twitter.com/options, facebook.com/theoptionsinsider. And we brought back the old voicemail line. We thought it'd be kind of fun to actually hear from some of you guys. We're calling it the volatility voicemail line. We're going to use it for Vol Views on the Vol Views is back on the air. But of course, all of our shows and all of our listeners can participate in that voicemail love. Just dial 773-669-4VOL. That's 4865. And we can actually hear your pretty little voices here on the old program. So call up, leave us a voicemail, 30 seconds, maybe a minute if it's really, really in-depth. And we'll parse it here live on the show. And that's going to do it here for this episode of Options Bootcamp. I don't think we can go any longer. I think John's lungs would collapse. So before we go, though, let me check in with each of my cohorts, my partners in crime, to see what they have cooking in their respective necks of the woods. Starting off with you, Mr. Major Domo, Mr. C. What is coming up in the land of Sogo?
Well, we have a new screener coming out in about a week or two. And I saw all the specs for it, and it looks really great. That's going to be for equity customers. But, of course, our option customers are, normally they start trading equity, so that will help them too. And what we have also, in testing is coming out soon, is what we call the famous Sogo Elite. I know everything's elite. But what I found out was that we have option charting. And there's very few places that have that. Now, personally, to be honest, I don't know how much usefulness that can possibly be to the average retail customer. We do get customers that do call up and say, I want to see how the January 2016 IBM options, the chart looks like. And it's very hard to get that anywhere. Maybe LiveVol has it, but we're going to have that with Sogo Elite. So that's a pretty good thing for those kind of customers. And as always, Twitter, Sogo Trade option, and of course on Facebook. And see you guys next week.
Hopefully a much healthier next week. We'll see. And last but certainly not least, Mr. P, what's coming up in the land of MTM?
Oh, we're rolling into the new year here, and what we're doing here just coming up, probably by the time this comes out, we'll be right in the midst of it. We are accepting applications for one-on-one coaching. At Market Taker, we have two coaches. There are two people in the world that I trust teaching my students with real hands-on one-on-one coaching. I'm one of them. My guy John is the other one, not John Critchley. I would trust him, but he's got bigger fish to fry over there at Sogo Trade. So John and I are the only two coaches who do the coaching, and we can't take on like 1,000 people each because there aren't enough hours in the day, because it's literally one-on-one and it's very hands-on. So basically what we do is 2 or 3 times a year, we literally accept applications for one-on-one coaching. And we've had some people graduate through the program, and that's what we're going to be doing at this time. So if anyone's interested in one-on-one coaching, you know where to find me, Dan at markettaker.com. It's 2 T's in a row, market like stock market, take like take something. So just email me personally, Dan at markettaker.com. I can get you out an application, or maybe even just chat with you via email and see if you're, have enough trading under your belt to make it useful to you, and see if you qualify for one-on-one coaching. And that is what's new with us. So if anybody listening is interested in one-on-one coaching, hunt me down, and if we still have some spots open, we'd love to chat with you.
Do you have to be elite to take advantage of that opportunity?
Mark, you have to be very elite when it comes to MTM. Elite traders.
That is for the uber elite.
But actually, you do, as a one-on-one coaching student, you get access to a whole lot more than just working one-on-one with us. You get access to all of our online content for life. You get access to our MTM Elite Traders Club, which is an online chat room on steroids. You'll love it. And a whole bunch of other stuff. So it's a really great program. It's a full blown out 6-month program.
All right, and check it out over there at MTM. You can learn a lot more at markettaker.com, or surf on over to sogotrade.com. Check out all the cool stuff they have cooking over there. Maybe sign up for an account, try some paper trading, fund that account, try some real trading, and put all this stuff we've been talking about on this show for the better part of the last year and a half, maybe even 2 years, into some practice and see how it works for you. And on behalf of John and Dan, and of course myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to this program and for making it such a success. And we'll see you next time right here on Options Bootcamp.
Options Bootcamp is brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when SoGo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.